Today, I want to talk about why I bought into Berkshire Hathaway quite aggressively with hundreds of thousands of dollars of my own money a few years back. I'm going to talk about the principles used, what my thought process was, how that's worked out, and why Warren Buffett is still the GOAT, the greatest of all times. But before we get into that, make sure you hit that subscribe button. Here at the Cashflow Academy, we want to bring as much education and know-how as possible to you each and every time we make a video. So hit that subscribe, click that notification bell. Let's get into it. Berkshire Hathaway. So Warren Buffett started Berkshire Hathaway decades ago and, of course, became widely respected as the greatest investor of all times. Now, Warren Buffett had a sidekick, Charlie Munger, and they believe in certain principles, and the baseline principle is fundamental analysis. And here at the Cashflow Academy, we believe in 4 pillars, and fundamental analysis is the very first pillar of our 4 pillars program. Why are fundamentals so important? Well, fundamentals tell you the value of something. You can basically look at valuing each part of the business and come up to an analysis of, okay, here's what I'm getting for what I'm paying. In Berkshire Hathaway terms, they value their own business like they value others. They say, okay, at various times, our stock is undervalued, and at other times, our stock is fairly valued or maybe even overly valued. And so they do analysis on their own business. Berkshire Hathaway is known as what's called a conglomerate. They have multiple divisions that operate across a variety of sectors in the marketplace. For example, they own Geico, a huge insurance company, but they also own Burlington Northern, which is a massive railroad operation. They also own See's Candies. So they've got a variety of businesses, and that's just to name a few. When you look at Berkshire Hathaway, you can add up the value of all these businesses and come to a sum amount, basically book value. What is our value of our enterprise, our total value of the business, and what is our stock price trading at? And sometimes the stock market becomes depressed and the stock gets really, really cheap. Other times the market's euphoric and the stock price gets quite expensive. Well, rewind back about 4 or 5 years ago, Warren Buffett and Charlie Munger, they are not short-term traders. They are certainly long-term investors, but they were analyzing Berkshire Hathaway's business and they said, you know what? We're just simply undervalued. And so they keep track of their enterprise value, their their price to book ratio, their PE ratios. They compare these things over time. And they say the market just isn't paying enough for what we have as a business. And so they instituted something called a share buyback program. This is perfectly legal. It's done by many corporations. Some do it well, some do it poorly. But a share buyback program is as simple as buying out other owners in the business. So let's imagine that you and I started a business together and you decided you wanted to cash out. Well, you could sell your share to me, right? And we'd have to come to an agreement on price. What a share buyback program is simply that. The corporation can go into the stock market and can buy out shares. So they're using corporate cash to buy shares. Every time they buy shares from an existing shareholder, those shares are now retired because the company has bought them back, bought them out of the market. So those shares become retired, meaning that nobody owns them. They basically go into retirement. That means that every existing shareholder now owns a bigger piece of the pie, right? If 10 of us own a business and we buy out 2 of the others, well, the existing 8 have a bigger share of all future profits. That's what a share buyback program is. And about 5 years ago or so, Berkshire Hathaway, which hadn't done a share buyback program aggressively in quite some time, they went with an aggressive share buyback program. And they were simply stating, in their opinion, Berkshire Hathaway shares were undervalued and they were going to use corporate capital to retire shares and to buy those shares out of the market and leave every existing shareholder with a bigger piece of the pie. And so they started to do that. And they're very transparent. They said, hey, we've initiated a multi-billion-dollar share buyback program, and here's why. And they talk about those in the annual meeting. They do a once-a-year meeting where you can go to Omaha, Nebraska, and you can actually, as a shareholder, participate in that forum and listen to Warren Buffett and the late Charlie Munger, when he was still around, talk about the share buyback program. Well, I bought in aggressively because by my work, they were undervalued as compared to the S&P 500. And this was on the back of a period of long underperformance. Berkshire Hathaway, for about 10 years prior to that, had really been trounced by the S&P 500. The S&P 500 had been like this, and Berkshire had done well, but not as good as the S&P. Now, I thought that those would converge. I thought that Berkshire would have a period of outperformance. Fast forward to today, that's certainly been the case. Even recently, as the stock market has fallen vastly off of its highs, Berkshire Hathaway is up year to date. So there's a big difference in value and fundamentals. But I'm not suggesting to rush out and buy Berkshire Hathaway today, because as they've outperformed for the past 5 years, guess what? They have slowed and even really massively reduced their share buyback program. So Berkshire Hathaway is not saying we're way overvalued, but they are saying we're not the bargain we were before. We're not there right here, right now. They have over $300 billion of cash in short-term treasuries that they're not putting to work in stocks. That's really an indictment of the fundamental values they're finding in the markets. They're saying, look, we're not finding anything that we're willing to pour a large amount of our capital into. We're not finding those bargains. Even our own stock is not the steal that it was 5 years ago. So will things open up? Will opportunities present themselves? I think so. I think the answer is a resounding yes, but it's going to require some patience. Bear markets typically last anywhere from about, 1 to 2 years. Since 1920s, if we go back a century, the average bear market is just over 18 months, if you look at the statistics. So you call it a year and a half. We're very new in this bear market cycle. There's more room to go. There's certainly more fundamental opportunity for things to get cheaper. We've gone through a period of euphoria, of excitement, and, to have a slowdown, to have some lower stock prices would be a very good thing. So I think they've created a war chest of capital. I think they will pounce when the opportunity's right, and they are very transparent. They will talk about much of what they're doing and why they're doing it during that period of time. So if you pay attention, you'll catch some insights. Here at the Cashflow Academy, we're going to be doing that fundamental work. We're going to be talking to our membership group about, okay, here's what we're seeing. And again, as we've said for the past few months, this is not a market where you want to be aggressively fundamentally investing. It is overvalued, one of the most overvalued markets that we've seen in our history. I've been around for 50 or so years, and I would say that it's fundamentally except for late 1999, it's about as overvalued as it's been on a long-term cyclically adjusted PE basis. It's just not the values out there. Will there be little opportunities? Can we find a diamond in the rough here and there? Sure, and we'll try to highlight those. But the nice thing about the way we do it is we don't have to sell all of our investments. We can do some hedging. We can do some protective stuff where we sell some options for income. We collar up some trades. We do some really fun things to generate some capital while the markets are stagnating here for a little while, and then be ready to pounce. And you have to have that education, that know-how, and build up your own little war chest of capital to be able to deploy when the market becomes a fundamental value and opportunity. And I suspect that day will come maybe in the next year or so. Thanks everyone for joining us. Make sure you hit that subscribe button to learn more about the Cashflow Academy. Come and visit us. check out the 4 Pillars program so that you can learn more about fundamental investing and do things the Warren Buffett way. Thanks for joining us. We'll see you next time.